But I'd like to get the stock of the day under our belts as per usual at the top of this program. Now, I'm just checking my screens because when I was keeping an eye on the market in the first hour of trade, we did have Computershare as the best performer. And that is, of course, because we are in a rising interest rate environment. If we know anything, we know that this week. The FOMC hiking rates by 75 basis points for the third time in a row. We have Jerome Powell saying that he's going to keep at it in terms of rising rates until inflation gets brought back under control. 6 central banks through the overnight lifted rates as well. So the outlier really is the Bank of Japan, or we could say the Bank of Turkey, which cut rates, believe it or not, through the overnight period, even though inflation there is running at around 80%. So the question is, for the stock of the day, would you be buying Computershare? And to help answer those questions and more, we're joined here in studio by Philip Pepe from Shaw Partners. Wonderful to see you. And remotely, Jun Bei Liu from Tribeca Investment Partners is joining us as well. So look, Philip, I'll start with you on the stock of the day Computershare question, because you have to be thinking about the macro when you're investing these days.
Absolutely, and days like today highlight just how fearful people are of further interest rate rises. And yes, I think Computershare is worth a buy despite its recent strong share price movements. They put out very strong guidance with their full year result for earnings per share up 50%. Now, a lot of that is because of the interest rate rises that they knew of at the time, and some of it is to do with their recent corporate trust acquisitions. They face some cost headwinds like many companies do. They are an IT heavy and labour intensive corporation, so those cost pressures are going up. But despite that, they put out a 55% EPS guidance, which may well prove to be conservative. Last financial year, about 10% of their revenue was interest income, but that's about 35% of their profits. That'll increase materially into FY23. They've got about 38 billion in cash and investment balances, and they're flagging 520 million in margin income. That's a material increase on PCP. So that's a very good, that alone is a reason to buy Computershare, I think.
Yep.
Yeah, CPU, absolutely to buy from me.
Okay, wonderful. We've started out this program pretty strong with a buy from Philip Pepe from Shaw Partners. Jun Bei, I think we've got you there. What do you make of Computershare given the inflationary and interest rate environment that we're in now?
Share price can move very, very quickly. Now, for Computershare, at this point, if you put the spot bond yield interest rate, future predicted interest rate in, it's probably come about 20 to 30% upgrade compared to consensus numbers. So for me, investors need to follow earnings. If the earnings is going to be upgraded by that much, share price certainly heading higher. And another point is, this company, as Phil touched on before, never used to make so much out of the interest margin, and now suddenly it's a big part of their earnings. And this company will generate so much cash flow just from those extra margins that they make. And that cash flow, at this point, market hasn't really considered what they're going to do with it, because they can use those to buy accretive businesses. Now, whether market will like it or not, it certainly is going to be very accretive using those excess cash flow that they previously didn't expect to have to reinvest into a business. So all of that are very positive for this company, and it's absolutely a buy at this point.